The following was recorded in front of a live studio audience at the Studio 21 Podcast Café. This is the United Podcast Network.
Welcome to the Stock Market Authority Podcast. I'm Bakes, Kevin Baker. I'm going to teach you how to make money in up and down markets. Very few podcasters or coaches cover this. I'll show you how to lock in profits and minimize losses to make you a better investor. So once a week, you're going to know what's going on in the world and the stock market. Welcome to the Stock Market Authority Podcast. Hey, welcome back to B3, Bakes Back to Basics, part of a series here that, frankly, my sons, Bobby and Jack, the reason I do this, asked me to do because I kind of lost them in the weekly shows. And I know I've been doing this for 30 years, and other people have not. And so I'm here to clarify and some topics that I've brought up in the past. And this is pretty fundamental, a word I pick definitely, is earnings and PE, price earnings ratios. And this is an example that I put up here. This is a fairly simple income statement. Yes, I can do fundamental work. Yes, I know I talk about charts all the time, but I've interviewed thousands of CEOs, thousands of CFOs, and I understand the power of earnings and valuing earnings and how that incorporates into stock prices and then eventually shows up in the stock charts. So I'm going to keep this fairly straightforward. This is a very simple income statement from Google. Doesn't have all the detail that would normally be there. But earnings are earnings per share. It's simply the revenues, the top line, sales that appear, and then all the expenses that are deducted to get to operating income. And I won't go through all the R&D, research and development, sales, general and administrative, all the expenses that get taken out to go from revenues, the top line, down to operating income. Then they get taxed, and it becomes net income, the bottom line. And then the bottom line, you divide by the number of shares outstanding, fully diluted shares, and you come up with earnings per share, 456 in this particular example. So that's simple. Top line, expenses, bottom line, divide by the number of shares, that's earnings per share. When you hear EPS, that's what people are talking about. When you're watching CNBC or other things and they say the company beat earnings, it's they came in above the analyst expectations. When I was on earnings calls, conference calls, which was part of the job, I would literally sit there, I would have their earnings results, and then I would have the estimates. And I'd have all the lines, and usually it was the high estimate of the analyst on the street, on Wall Street, and I wanted the company to beat what the analyst had for financial performance, for the bottom line. I wanted to beat the top line too. That's particularly important, revenues, but I wanted them to beat the bottom line. And if you beat the bottom line, that's called beating expectations. And if you raise guidance, which means you're raising what people think you're going to earn in the future, then the stocks tend to like that. So that's the reason we talk about earnings and EPS so much here. This is the case of Google. Recently, YouTube dragged on results and caused this earnings number to be disappointing. The earnings now are declining. This will segue into the PE part of the discussion. So you take the share price of Google, $92, the 456 is the earnings number that you see here. It's 20 times. That used to be reasonable. With the challenges of ChatGPT, I don't think that's reasonable any longer. So what I used to say is that I wanted to have if I looked at a company and I saw that the PE was reasonable this year, and I thought it was logical that they could beat the high end of the estimates for next year and keep that PE multiple, and you'd make decent amount of money, that would be great. If the PE multiple went up, so much the better. So in the case of Google right now, I don't see that going on. I think ChatGPT is a real threat, and I think this is going to play out. So the higher the growth rate, the higher the PE multiple that people will put on a stock. When earnings are declining, you're not going to see that multiple expansion. Things really get fun when people beat earnings and the multiple expands and they raise guidance. And that's what we're all kind of searching for. It's become more difficult to attain over time. And let me just go to the chart here. My point about this is, yes, I love fundamentals. I want to see earnings growth. I want to see PE multiple expansion. But the stock has started, and the chart has indicated that it sniffed out problems a year ago. And so that's why I incorporate both. I want to have a strong chart, and I want to have a great earnings story for individual stocks, and I want to have a PE that's reasonable and has a chance of expanding. So that's B3, Bakes Back to Basics. Please come back to me with other topics you'd like me to cover. If you like this segment, if you don't, bakes@stockmarketauthority.com is my email. DM me on Twitter @BakesTakes_, and please go to my website, stockmarketauthority.com. Sign up for free as I break in with these stories going forward. Thanks so much. See you soon.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Cafe, the United Podcast Network, its partners, or affiliates.